4 new dividend increases you need to know about. The hunt for reliable dividends just got a whole lot easier. Get ready to discover 4 incredible companies that are boosting their payouts, putting more money directly in your pocket. In today's volatile market, securing reliable income is more important than ever. Luckily, several companies are stepping up by increasing their dividends. Let's explore 4 fantastic options that could supercharge your portfolio's income stream. Number 1. Chubb. Let's kick off our list with Chubb Limited, or CB, a company that recently announced a promising dividend increase of around 6%. This news has investors buzzing, and for good reason. Here's what makes Chubb an interesting prospect for your portfolio. Chubb grabbed headlines when it was revealed that Warren Buffett's Berkshire Hathaway took a significant position in the company. This move by the legendary investor signifies his confidence in Chubb's future. In fact, Chubb now sits at Berkshire Hathaway's 9th largest holding, showcasing its importance within Buffett's portfolio. Chubb's stock price has been on a tear, rising over 36% in the past year. Interestingly, the announcement of Buffett's stake further fueled this growth, with the stock jumping an additional 7% in just a month. Now let's delve into Chubb's dividend profile. While the current starting yield of 1.38% might not seem like much, there are compelling reasons to consider Chubb for its dividend potential. Firstly, Chubb boasts a healthy free cash flow, which is the cash remaining after operational expenses are paid. This free cash flow has been growing steadily, indicating the company's strong financial health. Secondly, Chubb's dividend payouts are well covered by their free cash flow. The ratio of free cash flow used to pay dividends, or free cash flow payout ratio, has been steadily decreasing. In 2017, they used 29% of their free cash flow for dividends, but by 2023, that number dropped to a mere 10%. This low payout ratio allows Chubb ample room to increase dividends in the future or invest in other areas for growth. While Chubb's historical dividend growth hasn't been spectacular, averaging around 4% over the past 5 years, their recent 6% increase hints at a potential shift. With their low free cash flow payout ratio, Chubb might prioritize higher dividend growth moving forward, making them an attractive option for income-seeking investors. Overall, Chubb Limited presents a compelling combination of strong financial performance, a growing dividend, and the backing of a legendary investor like Warren Buffett. This makes Chubb a stock worth keeping an eye on, especially for those seeking reliable income with growth potential. Chapter 2. Parker Hannifin. Now let's shift gears to Parker Hannifin, or PH, a company with a truly impressive pedigree. Buckle up, because Parker Hannifin is no ordinary dividend stock. It's a dividend king. This elite group boasts companies that have increased dividend payouts for over 50 consecutive years. However, unlike some dividend kings that struggle with stagnant growth, Parker Hannifin defies the stereotype. Here's why this company deserves a spot on your income radar. Many investors might shy away from companies with low starting yields, like Parker Hannifin's current 1.23%. But with Parker Hannifin, the low yield is overshadowed by their exceptional dividend growth trajectory. Just look at the numbers. Their 10-year dividend growth rate sits at a staggering 12.16%, and the 5-year rate is even higher at 13.91%. This translates to real growth. Their dividend payments have skyrocketed from $1.78 in 2013 to a projected $6.52 in 2024. That's impressive growth for any company, let alone a dividend king. But dividend growth isn't sustainable without a strong financial foundation. Here's where Parker Hannifin shines again. Their free cash flow, the cash available after expenses, has been growing rapidly alongside their dividends. This means the company isn't stretching itself thin to pay out dividends. It's growing its financial muscle and using a healthy portion of that growth to reward shareholders. The proof is in the pudding. Parker Hannifin's free cash flow payout ratio, which measures how much free cash flow is used for dividends, has consistently stayed below 30%. This low ratio indicates ample room for future dividend increases, making Parker Hannifin a compelling option for investors seeking long-term sustainable income growth. While Parker Hannifin's track record speaks volumes, their recent performance shouldn't be ignored. The company's stock price has soared over 64% in the past year, showcasing strong investor confidence. Parker Hannifin offers a rare combination: the security of a dividend king with the exceptional growth potential of a high flyer. This makes it an attractive option for investors seeking a reliable income stream with the potential for significant capital appreciation. Chapter 3. Ralph Lauren. Let's move on to Ralph Lauren, or RL, another company that recently announced a noteworthy dividend increase of 10%. Their stock performance has been impressive, surging over 67% in the past year. However, while the headline of a double-digit dividend hike might be enticing, it's crucial to look beyond the surface. Here's why Ralph Lauren requires a cautious approach for dividend investors. While the recent increase is positive, Ralph Lauren's dividend history exhibits inconsistency. Notably, they cut their dividend payments entirely in 2020. This lack of consistent growth is a red flag for investors seeking reliable income streams. A crucial metric for dividend sustainability is the free cash flow payout ratio. This ratio indicates how much free cash flow is used to pay dividends. A higher ratio raises concerns about the long-term viability of these payouts. In Ralph Lauren's case, the picture isn't pretty. Their free cash flow payout ratio for the past year sits at a concerning 102%. This means they used more than all their free cash flow to cover dividend payments, raising questions about the source of these payouts. Compounding the issue is Ralph Lauren's declining free cash flow over the past 3 years. This trend directly contradicts the needs of a sustainable dividend strategy, where free cash flow should ideally be growing. Beyond the dividend picture, Ralph Lauren's debt-to-assets ratio has been climbing, indicating a growing debt burden. Additionally, their return on invested capital, or ROIC, has dipped in recent years. ROIC is a profitability metric, and the low ROIC suggests the company isn't generating strong returns on its investments. While Ralph Lauren's recent dividend increase might seem attractive, the underlying financial picture raises concerns about the sustainability of these payouts. For income investors seeking reliable dividend growth, Ralph Lauren might not be the most suitable option. Chapter 4. Reality Income. Our final company for today is a favorite among income investors, Reality Income, or O. They recently announced a 2.1% increase to their monthly dividend. It's important to remember that Reality Income increases their dividends quarterly, so this translates to roughly a 3% annual increase. While the individual quarterly hikes might seem small, Reality Income boasts a long history of consistent dividend growth. Their track record speaks for itself. 3-year dividend growth rate is around 4.15%. 5-year dividend rate sitting at around 3.55%, and 10-year growth rate is 3.81%. This consistency is crucial for investors seeking reliable income streams that grow over time. Another key strength of Reality Income is the sustainability of their dividend payouts. Unlike traditional companies that rely on free cash flow, REITs like Reality Income use adjusted funds from operations, or AFFO, to pay dividends. Their current AFFO payout ratio sits at a healthy 74.62%, indicating ample room for future dividend increases. Reality Income offers a compelling dividend yield of around 5.88%, making it an attractive option for income-focused investors. This high yield, coupled with their track record of consistent growth, creates a strong income stream for shareholders. One aspect to consider with Reality Income is their increasing number of shares outstanding. REITs are required to pay out 90% of their earnings as dividends, limiting their ability to reinvest profits back into business. To maintain growth, Reality Income has chosen to issue new shares. While increasing shares outstanding can dilute existing shareholder value, it's a common practice for REITs. If Reality Income can effectively utilize the capital raised through new shares to grow at a healthy rate, this strategy can ultimately benefit all shareholders. Overall, Reality Income presents a compelling package for dividend investors. And there you have it, 4 exciting companies that just upped their dividend payouts. If you found these insights valuable, be sure to hit that like button and subscribe for more financial content. I'll be here uncovering the best income-generating opportunities to help you build a strong and sustainable portfolio. Let me know in the comments below which company piqued your interest the most, and what other topics you'd like to see covered next. Thanks for watching.